Bitcoin can have a cycle like that where if you break the 4-year cycle, you have an up year, institutions are positioned, and it starts to rip. You can bring in retail. So it's like just because retail's not here now doesn't mean they can't come later. And unfortunately, retail tends to be kind of the later phase of a given bull run. That wealth effect can reduce then consumer spending. You can have things like Bitcoin get caught up in it, which is why I separate. When I say nothing stops this train, I'm talking about the fiscal deficits and the liquidity to keep fueling the fiscal deficits, which over the long run does have implications for asset prices, but it does have implications for asset prices on a year-by-year basis or a quarter-by-quarter basis. You can get all these crazy fluctuations. Valuations do matter in the longer run.
That Bitcoin can, and in future cycles likely will, experience the same institutional first, retail later pattern. The absence of retail now is not a sign of weakness. Retail tends to show up late, she says bluntly. But if Bitcoin breaks its 4-year cycle with an early institutional breakout, retail could flood in. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
So the short answer is it hasn't surprised me because, so back when gold was like 3,000, one of the interesting things at the time was that it was not retail driving it. So when you looked at like interest in gold ETFs or interest in physical coinage, it was kind of lukewarm, whereas the price was going up anyway, and it was because sovereigns and institutions were driving it. It was kind of like gold's moment of like the treasury company thing, right? It's like big pools were interested in it. China and India were interested, so their retail was interested, but kind of the Western retail was like other things are going on. When the Mag 7 was soaring, no one's like, they're like, yeah, gold's okay, but you know, I'm not really interested in it. It's only really in kind of the second half of this year where Western retail did start to FOMO into gold. So that's kind of a later stage portion of it. So first institutional, then retail, and that's generally how things go. So if anything, if you'd asked me last year, I'm surprised there's not a little bit more retail FOMO than there is right now. But then I would also not have guessed you gotten to 4,000. But when you do get to 4,000, I'm not surprised that, yeah, you start seeing lines outside of gold stores, either to buy it or sell it, because actually both tends to happen. There are people that need money and have, you know, a gold ring and they want to go sell it. And there are other people that are then FOMOing into it, is how these things tend to go. And, you know, Bitcoin can have a cycle like that where if you break the 4-year cycle, you have an up year, institutions are positioned, and it starts to rip. You can bring in retail. So it's like just because retail's not here now doesn't mean they can't come later. And unfortunately, retail tends to be kind of the later phase of a given bull run. Now, but I think I view gold in a similar way that I would view AI, which is that it can get into a local bubble, but that I still think it's structurally fine. The last time I gave a warning of that sort was back in 2020. Gold, of course, had a very big moment. And I was like, I could see it taking a breather here. It took a little longer breather than I thought, but then it did this whole kind of next doubling that it did. And I view it kind of similarly, which is sure it's over its skis right now. But I don't view it as like structurally overvalued. If anything, it's going from being just kind of structurally undervalued to like back closer to like what I think makes sense. And so, yeah, I just view gold and Bitcoin as kind of two different assets. Gold still, because it's the incumbent, it has more of a risk-off aspect to it. It's got more of a sovereign interest in it. Whereas Bitcoin is still kind of collectively lumped into a tech play, even though from those that deeply understand it, it does have, digital gold, digital cash attributes that can be viewed as risk-off as well. Just the price action tends to correlate more with a risk-on type asset.
That makes
fiscal dominance in general chips away at Fed independence. Like the fact that the Fed is going to go back to increasing their balance sheet in line with nominal GDP, one of the challenges there is that the fiscal deficits, the size of them, contribute to nominal GDP. It's one of the inputs into that. So basically, the Fed is kind of indirectly saying our rate of balance sheet increases will be partially dependent on how big the fiscal deficit is. And so that's already at least a minor reduction and a kind of a a persistent reduction in Fed independence, I would argue. Now, what they mean generally by Fed independence at the root layer is that there's at least some separation between like near-term rate decisions and the election cycle. So it'd be very bad if like incumbent administration could say, okay, cut interest rates right now a ton because we got an election coming up, and then go back and maybe raise them. That's kind of the cycle they try to avoid. There's no such thing as pure Fed independence. It's more like how acutely can the Fed kind of operate on their own terms. Now that, again, you can call into question the entire purpose of the Fed. Should a central board of 12 people be setting interest rates? I would argue no, but it's still the case that you have a somewhat independent board doing it. Even if they replace, a couple governors at a time, you still generally are likely to have some degree of independence where they don't want to look like a total sham, especially because it can backfire. If they look super dovish, the bond market could freak out and say, well, I don't want to own any duration yet. So if they perceive the Fed as acting too political, they could sell off mortgages, the market, and you could get higher mortgage rates even if you have short-term rates, which is not what let's say a hypothetical like Trump stooge Fed, they wouldn't want that. Mm-hmm. So they always have to project some degree of kind of pseudo credibility to say, here's what we're doing now. So I wouldn't expect like just a 180-degree change in what they're doing, but that's separate from the fact that because they're in fiscal dominance, like they're going to go back to increasing their balance sheet even if inflation's above target, because it's keeping the treasury market kind of liquid. And I mean, they have other variables they could tweak. I mean, they can tweak the supplemental leverage ratio, which sounds really wonkish, but it's almost like a shadow QE for banks. It just kind of frees up some of their liquidity constraints that they have and allows them, it kind of, for them, acts like QE. And so there's various levers they can pull, but all those levers have in common is that they allow kind of the existing thing to keep going without causing acute liquidity constraints. So just the train keeps going, the fiscal deficits stay high, the Fed doesn't go out of their way to stimulate, but they do keep a lid on little fires that pop up, and it just keeps running at this kind of stagflationary pace.
Lyn, is there anything else on the macro side that you want to touch on? I just have a few questions on gold before we close out.
Right. The other one would, I guess the final touch would be AI, in the sense that if you get like a rollover in really big asset prices, whether it's Nvidia, Apple, Microsoft, things like that. I'm not predicting it, but like that's where you can get kind of a disconnect where the Fed could be stimulating, the fiscal could be stimulating, but if you got a multi-trillion-dollar destruction in just kind of capital, that wealth effect can reduce then consumer spending. You can have things like Bitcoin get caught up in it, which is why when I say nothing stops this train, I'm talking about the fiscal deficits and the liquidity to keep fueling the fiscal deficits, which over the long run does have implications for asset prices, but it does have implications for asset prices on a year-by-year basis or a quarter-by-quarter basis. You can get all these crazy fluctuations. Valuations do matter in the longer run. And instead, it's more of like that macro backdrop that gives you a foundation that other analysis can then be done on top of.
On the AI side, there's a lot of talk of like AI bubbles. There's these sort of circular deals between Nvidia and Oracle and all these major companies. Do you think we are potentially in a bubble in the AI side?
I think we're kind of in this like euphoric kind of local bubble phase, most likely. But that I think the underlying trend for the most part is real, which is that this is a pretty big transformation in especially white collar types of work. Kind of like how if someone asks, was Bitcoin in a bubble in 2017? It's yes and no. It's like a local bubble built on a structural thing. That's kind of how I view AI right now. Maybe less extreme, but it's kind of saying, sure, I think certain things are overdone. Sure, I think euphoria is high. It's crowded. Some of the deals have become somewhat incestuous in that sense, and you get that kind of circular aspect, which can be frightening. But that I do think that when that kind of washes out, I think that still sets the stage for growth. So I do think that when we look back for 10 years from now, will there be quite a lot of data center activity running AI that's doing all sorts of stuff for us? Yes, and in bigger numbers than they are now. but that occasionally you front run and kind of pull too much forward and have to cool off for people.
But markets have almost certainly front-run years of future growth, and a cooling phase will likely come. That cooling, however, sets the stage for the next leg upward. AI, in her view, will be as transformational to white-collar work as industrialization was to physical labor. But as with Bitcoin in 2017, a structural bull market can still experience nasty local bubbles.
I don't have a view of the next quarter. I always do try to avoid price predictions. When I get quartered into one, like for 2025, I was like, yeah, anything under, like, if we don't hit 150, it'd be a little disappointing. Of course, we only got to like 125 or so, so it's on the disappointing end. I do expect that, in 2026, we'll be back into the six figures. I mean, anything can happen between now and year end. And whether it's 2026 or 2027, I think we'll be seeing new all-time highs, most likely. And it's funny when I watch Twitter sentiment. When Bitcoin is absolutely soaring, I get sometimes dunked on by Bitcoiners saying, why do you own any gold? Why do you own any stocks? Why aren't you 100% Bitcoin? And it's like, well, because I like some degree of diversification here. And then when Bitcoin's crashing, I get the gold bugs coming out saying, they should just own all gold. They're like, why do you own any Bitcoin at all? And it's like funny how that emotional trend goes. And one of the ways is to say, okay, well, you don't want to diversify so that you own a little bit of everything. You still want to have opinions on assets, and you can make concentrated bets. I mean, I'm quite structurally bullish on Bitcoin, for example. But that's also why I own gold and I own equities that have nothing to do with Bitcoin, because there are different size markets, different performance kind of patterns that they go through. And then for me, it's not just about owning what I think is going to be the fastest horse. It's okay, I'll put extra on the fastest horse, but I want to own a handful of horses. And so when you structure a portfolio like this, it's like, well, okay, I'm disappointed in Bitcoin this year, but I'm I'm enthused by what gold did. And if you structure a portfolio that way, you take the edge off for a lot of these things. And so, I think we'll see a rotation at some point. Where I'll be disappointed in the gold side of my portfolio, and I'll be enthused about the Bitcoin side, and then probably it'll repeat again. So, nothing's really changed around my view of any of these assets. It's just they catch on at different speeds, and they have different correlations. And like I said before, I think that a year ago or 6 months ago, some percentage of people bought Bitcoin for maybe the wrong reason. That they they bought it because they think Uncle Sam's going to buy it, rather than buying it for its own qualities and kind of the longer term story of what it is and what it changes. In addition, I think the broader crypto space is basically out of narratives, and that's basically dead weight now. So other than Bitcoin and stable coins, a couple small tech rails to run that kind of stuff. At a macro scale, there's really no there in the broader crypto space. And so I think that's part of why kind of the whole space is bearish, because a lot of people that own Bitcoin own other assets, and they view it as not just a bad cycle, but that there's just, what's the next narrative? You had ICOs, you had NFTs, you had DeFi, you had meme coins, which is basically the most cynical narrative, is saying that we're just flat out saying there's no there. Then even that kind of eventually rolls over, and there's really no kind of, you can always be surprised by another one kind of coming out of the hat, but I think a lot of that has kind of tested almost every directional narrative that it could, and is kind of set for structural stagnation. So Bitcoin has to kind of decouple from that dead weight to the extent that it's going to keep kind of reaching higher highs.
What do you think will happen with interest rates?
So first answer is, I think that's one of the kind of the minor catalysts for why Bitcoin might have sold off recently, is that the market had to kind of readjust to slightly less dovish Fed, potentially, for the remainder of this year. Now, one rate cut is not like a giant story, but when the market was expecting A and then they get B, even if B is not that different, it does have to kind of reprice things. And when you already have a spooked market for other reasons and you get these repo issues and stuff like that, it's not that surprising to see frictions in especially the most volatile parts of the market. So there's that. I generally don't have great insight in what they're going to do in a given FOMC meeting. Mostly whatever the market says is almost always what happens. And then the problem is it's recursive. Like, the Fed governors do look at what the market is expecting, And if the market is way off course of what they're intending to say, that's when Fed speakers usually come out. And if the market's too hawkish, then they'll come and say some dovish things. If the market's too dovish, they'll come in and say some hawkish things, and they try to get it a little bit closer to what they kind of are already anticipating what they're going to do. So rather than try to play that game, I kind of focus on the longer term. I do think that within 2026, we will see a handful of rate cuts. Whether or not we have one in December or not, for me, is like a coin flip right now. And it's more about what happens next year. So yeah, I think we'll see mildly lower interest rates, while we're also going back toward balance sheet increases. But I think that they're largely separate variables. You don't have to have one to have the other.
Gold would have this insane bull market while Bitcoin was flat. I would have put that at pretty low probability. Why do you think that's happened? What's going on there?
Well, it's funny because I've been a gold bull, but I'm surprised as well that it hit 4,000 this year. When it was in when it still had a 2,000 handle on it, I was kind of eventually looking forward to the 3,000. But I didn't think you'd kind of just race right to 4,000. So I'm happy it did, but wouldn't put it as my base case, especially given the size of the market. It's a huge kind of multi-trillion-dollar market cap increase in it. There's multiple shifts happening. One is ever since 2009, you've had a gradual shift towards sovereign reaccumulation of gold. So prior to then, you had a multi-decade kind of divestment of gold among sovereigns and toward treasuries. Starting in 2009, that gradually reversed. It got kicked into overdrive in 2022 because then you have potential risk of confiscation or freezing of assets. If a sovereign is holding their securities of another nation, they're not really sovereign assets. And so there's kind of been a shift toward that. Then there's the increasing awareness of fiscal dominance and the increasing awareness that nothing stops this train, which says, well, if this is just going to happen for 5, 10, 15 years, maybe I want to own some gold. That's the one that's got an established track record. So big pools of capital already know what to do with it. They don't have to research it. They already know what gold is. And then in addition, this is not really, even though the stock market is near all-time high, it's because it's so narrow, it's mostly not even a risk-on environment. Like I mentioned before, we've been in an unusually long period of kind of like flat yield curve, PMIs, like purchasing managers indices of like manufacturing and other signs that are just kind of like in stagnation. Outside of AI, the stock market is pretty flattish, kind of consolidating. And so it's not a very risk-on environment, even though liquidity is good. So when you have kind of pretty decent liquidity up until maybe very recently, and then you have kind of stagnating broader economy, the Fed still trying to tighten things where it can, the things that have taken off has been AI, gold, like kind of what the market ironically looks as low risk. They view AI as low risk, even though the pockets of it that are obviously not, but they view it as low risk because they view it as like a sure thing. It's like, okay, that's cycle resistant. Let's go to AI. Then they say gold. Okay, that's low risk. Bitcoin, until pretty recently, was in that bucket, where it's benefiting from liquidity, from kind of gradual adoption. But as you have kind of like a flattish environment, Bitcoin cooled off. So I think basically gold's behaving kind of, rationally, just a little bit. These things tend to not be linear. So you tend to overshoot to the upside, then overshoot to the downside, then overshoot to the upside. So this did overshoot to the upside faster than I would have thought. But I think it's a gradual realignment for things we've talked about in prior podcasts, a more multipolar world, less kind of a focus on every country just holding one country's bonds as the reserve asset and saying, okay, we'll hold those, but we also want to hold these other, say, 3 things. We want to hold gold, maybe we want to hold another trading partner's currency around the margins. Smaller ones might say, well, let's look at Bitcoin a little bit. You get that kind of gradual broadening of assets that are viewed as kind of reserve assets. And gold, as the incumbent, is kind of been the chief beneficiary when we're talking about the markets being increasingly spooked about these tens of trillions of dollars of sovereign debt. So whether it's the US, it's Europe, it's elsewhere, the market is kind of long-term says, okay, what's the end game here? And you have gold, which is a much smaller market despite being huge than those sovereign bonds. It only takes a small gradual spillover for investors to start kind of going into gold. They don't have to do a ton of research because they know what gold is.
Gold is doing what it always does in times like these: assert itself. Bitcoin is still maturing, still correlating with tech cycles, but structurally positioned for long-term strength. And the Federal Reserve, despite its posture of control, is increasingly forced to follow the path that fiscal realities dictate. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.